Good afternoon, ladies and gentlemen. I'm delighted for this second session to introduce our panel of speakers. But to start off with, we have a short presentation followed by questions and answers. I'll take only a couple of questions, and then we proceed with the panel speakers, followed by Q&A at the end. So any questions, please keep them until the end of the presentation and the panel session. I'm delighted to introduce Bartosz Golba, who is the head of content for wealth management from Global Data, who will give us a short presentation. Thank you very much.
Thank you, and good afternoon, everyone. I hope you all enjoyed your lunch and are all set for the afternoon. So my name is Bartosz Golba, and I head the team of wealth management analysts and consultants at Global Data. We are a London-based data and insights provider, and we run market research and surveys across the number of industries, financial services and wealth management being one of them. I'd like to take this opportunity to thank the organizers for the opportunity to speak and to meet you all here at this magnificent venue. And I'm really happy that I can be here. What I'm going to do is share some of the insights or some of the findings from Global Data's research that are related to inheritance planning and succession planning, obviously. There will be quite a few charts in my presentation, but I hope, and a lot of data, but I hope you will find it enjoyable anyway. I can actually promise that you will be the very first people to find out some of the insights that I'm going to show today, because we just finished our annual survey of wealth managers, and the results of the survey haven't been yet published. Interestingly, our ongoing research and work finds out that succession planning and intergenerational transfer in general are one of the biggest challenges the wealth management industry is facing. And actually, this is not just wealth management industry as private bankers or advisors, but also clients. They need to face the challenge of inheritance planning as well. I used to work as a private banker myself, and I very well know that clients are not always happy to talk about passing on their wealth, and this is often a not only sensible but just difficult subject to talk about. But let's talk about it. So for start, let me set some context about the wealth management market in the Middle East. The vast majority of countries in the region can be considered emerging or frontier markets. Only I think Israel is the only in the region that is considered a developed economy. And generally, developing markets across the globe have been growing quickly in terms of the value of wealth or liquid assets or assets in general held by individuals in these markets. And the Middle East is not an exception. The value of assets held by high net worth individuals or millionaires has been growing quickly, as this chart illustrates. The double-digit growth rates in the past haven't really been a surprise, or they haven't been a surprise. There were a few bumps on the road, like financial crisis or decrease in oil price, or more recently Qatari crisis. But nevertheless, I think there's no doubt about it that the number of millionaires, high net worth individuals in the region has been growing, as this chart illustrates. Going further, we forecast the number of millionaires in the region to grow, to continue to grow, even if at slightly lower pace than in the past. And only looking at historical growth, only Central and Eastern Europe, this is the only region outside the Middle East that has been growing at a faster pace in terms of high net worth wealth generated by or held by the millionaires. Currently, as per our data, there are more than 130,000 millionaires in the Middle East, and they together have more than $720 billion in wealth. That's a lot of money, I think, and such growth as well can't be forgotten and ignored by wealth managers. So there are more and more providers who enter the wealth management market in the Middle East because they want to engage with this high net worth population and take their share of the pie of the business. So let's have a look at this high net worth population in the Middle East. There are two important points that I would like to make in terms of demographics of high net worth individuals in the region. First of all, our data shows that high net worth individuals or high net worth population in the Middle East is aging. This is not unique to the region. This is actually a global trend. If you look at top 100 billionaires at the Forbes list, the average age is, I think, 68. And in the Middle East, 40% of high net worth population is already over the age of 60. This means that they have to start thinking about succession planning and inheritance planning, and they have to think about the next generations who are to take over their wealth. The challenge is, and this is the second point I'd like to make, that only 5% of these millionaires who current millionaires in the Middle East region have gained their wealth through inheritance themselves. Most of them have been working hard to generate the money. It is either earned or generated through different business ventures. This means that they are not, well, probably it's not fair or accurate to say that there is no tradition of passing on wealth in the Middle East region. But the thing is that majority of current millionaires didn't have to worry about inheritance, didn't have to think about it at all. And this is where advisors or the industry, in my opinion, should really react. So the question is, does it react? I mentioned the Wealth Managers survey that we ran this year, and United Arab Emirates is one of the countries that we surveyed, so I'll share some of the insights from this particular country. What we found out is that more than a third of wealth managers operating in the country providers focused on high net worth segment, don't offer inheritance planning services at all. And again, the demand for these who actually do offer such services don't experience high demand. So this is the chart on the right-hand side, comparing the level of demand for inheritance planning in different countries. This horizontal line is a global average. So UAE is below global average. Turkey is actually even lower. Turkey is quite an interesting example itself because the high net worth population in Turkey is even older than in the UAE, for instance. But again, the demand for inheritance planning is quite low. And I dare to say that this is millionaires' advisors' duty to educate their clients about the importance of inheritance planning, of succession planning, and also about potential consequences of not having such a plan in place. UAE actually is also a perfect example to talk about local market conditions, which should be taken into account when talking about any inheritance planning service or advice. So obviously, or maybe not, but high net worth population in UAE is dominated by expats. Many of them have at least a share of their wealth held outside the UAE, maybe in their country, in their home country of origin, which means they potentially will like to maybe repatriate some of their wealth and think about inheritance planning in their country of origin. There is no inheritance tax in the UAE. Again, something to take into account, and this is not common across all the other markets. Think UK, for instance. And inheritance rule in the UAE follows Sharia rules, so there is also a limited amount of flexibility when you think about will planning or succession planning. And interestingly, that's also UAE specific. The demand for pension and retirement planning across high net worth population in the country is actually growing, and it's much higher than for inheritance planning. I'm not sure if you see the link here, but actually the natural next step after planning retirement or pension income is talking about inheritance. This is something the industry can take into account and start talking simply with their clients about passing on their wealth. And how is it done in other markets? I'd like just briefly to talk about Taiwan, one of the markets we also survey, and one of the markets I chose here because it's really interesting. So the majority of high net worth wealth in Taiwan can be attributed to the rapid industrialization of the country, of economy in the second half of 20th century. Many fortunes date back to this period, but this again means that many of today's millionaires in Taiwan are actually aging, and they are indeed thinking about passing on their wealth to their children or grandchildren. The thing is that surprisingly, their children and grandchildren are not that interested in inheriting this wealth. Well, maybe they are interested, but they don't interested in inheriting wealth, but not necessarily in taking over the business venture or entrepreneurs that are run and enterprises that are run by current millionaires. The entrepreneurial spirit in Taiwan is present. Younger generation also starts businesses and their own business ventures. The thing is that they want to run their own businesses and do it independently. So there is this disconnecting because one generation has businesses that wants to pass them on. The other doesn't really want to take them, surprisingly and paradoxically. But these two generations, what they have in common is trust in advisors. Both generations are actually working really closely with their bankers, with their financial advisors, and this is an obvious link, an opportunity for wealth managers or financial advisors operating in Taiwan. They can try to act as almost intermediary between younger and older generation, and just, by the way, make some money out of it. And I believe that actually engaging with more than one generation is also one of the biggest challenges that the industry, the wealth management and private banking industry is facing. And there are competitors globally who do their best to engage not only with their current high net worth individuals, not only with heads of families, but also with younger generations. And this can be done by educational programs, by different events, or even providing simply and efficiently financial advice for those who might not be necessarily high net worth individuals today, but who are likely to become high net worth individuals when they inherit their wealth. And what's important to note is that the different studies show that up to 90% of clients switch their advisors at the point of inheriting wealth from their parents. So if advisors fail to engage with younger audience, they might simply lose business in the not that far future. So to sum up briefly, I dare to say that we all agree that intergenerational transfer is inevitable. I haven't talked much about the reasons why high net worth individuals should should think about inheritance planning, but if not me, then the other speakers will certainly cover that subject. Second thing, although it is a sensible topic, really, a sensitive subject, after all, who would like to talk about passing their wealth to someone else? Advisors and bankers have to and have no other choice but to make use of their expertise and build on their relationship, leverage their relationships with their clients to educate them, to talk about threats and opportunities that come along with inheritance and succession planning. And the sensitive nature of the subject actually requires that this is done wisely, taking into account not just local market conditions I mentioned, but also specific needs of a specific client, specific family, and obviously every client is different. In my view, the key to success in this whole is building bonds and relationships also with the younger audience, with not just current millionaires, but millionaires of the future, and working together with not just one, but as many generations in the family as possible. And on that note, I would like to conclude. Thank you. And I'm happy to take a question or two if there are any.
Any questions?
I will be available in the afternoon if you would like to ask any questions in private. So thank you very much. And
thank you,
over to
Bartosz. Thank you very much. Thank you. Well, that tees up very nicely our panel discussion on inheritance planning in the Middle East, the current landscape and lessons from other regions. We'll have a brief introduction of our panel speakers, starting with Hussam at the end, please. Hussam Nasrawin.
Good afternoon, everyone. So my name is Hussam Nasrawin. I'm based in Abu Dhabi. I'm the CEO of the company GDC Partners. It's a company shared by His Excellency Mubarak bin Hamouda, who is member of the bin Hamouda Group. The bin Hamouda Group is one of the largest family business in the UAE. They are the local partner of several groups such as Chevrolet, Cisco System, GMC Motors, and Opel, and many others, Mina Corp, and others. So basically, our job is to invest in companies, mainly in Europe, and we also help companies, international companies, to set up in the UAE and in the GCC region. We offer them support to succeed in the region as local partner, and we are also offering advisory services.
Thank you, Hussam. And Michael Addison of UBS.
Thank you. Yeah. So good afternoon, everybody. My name is Mike Addison, and I work for UBS in Zurich, in Switzerland. I'm part of a team that's called Ultra High Net Worth Global Family Office Wealth Planning. And what that means is that we're essentially a group of tax and trust lawyers, and we help ultra high net worth or family office clients who are booked with the bank in Switzerland with cross-border tax and legal and succession planning topics. In my case, I spend my time split between Saudi, the Gulf, Turkey, and Russia, so it's a bit of a diverse set of markets, but there are certain common trends and similarities that one sees throughout that sort of crescent of countries. So.
Thank you, Michael. And our third panelist is Mohammed Hilal of Al-Hussein Holding Company.
Yes, good afternoon, everyone. My name is Mohammed Hilal. I am working as Group Investment Director for one of the largest diversified businesses group in Saudi Arabia, Al-Hussein Holding Company. We have diversified businesses in different segments. Mainly, we have three platforms. We have the retail, food and beverage, and FEC, family entertainment centers. My main role actually to oversee and supervise the funds of the family, and in terms of the strategic investment and also for the financial investment. Before joining Al-Hussein, I spent 5 years working with a different family group in Eastern Province in Saudi Arabia also. And before coming to Saudi Arabia, I spent 5 years working with the Sovereign Wealth Fund of Oman in Muscat.
Wonderful. Thank you so much, and welcome, gentlemen. Let's jump in with some statistics. It seems that over 90% of the companies in the Middle East are family-controlled or family-owned, but a small proportion of those companies, around 30-40%, have any sort of prepared succession planning. This is a huge lack of preparedness. Your thoughts, Hussam, on that lack of preparation of succession planning?
Today, I think it's the biggest challenge for all the family business, the succession. Why? Because usually the father or the grandfather, when he built the company, it was another world. You know, most of the countries were built thanks to family businesses. So they were involved in the infrastructure, in the building of the country. So they had the vision. They were entrepreneur. The problem is that when the company grew up, the kids, the children grew up with the money. They already have the money. They don't have to build everything from scratch to be an entrepreneur. So they don't have this vision or maybe this passion. So this is a huge problem. And today, when, as you said, less than 30% of the companies survive to the second generation, we can say that less than 10% survive to the third and around 5% to the fourth. Why? Because there's always a conflict, etc. So this is why it's so important to have a long-term vision, a strategy for each group in order to prepare the succession. And it's not done today in most of the companies.
Yeah, so Michael, the obvious fault line here is the lack of succession planning. How would you tackle the sensitive issue of the founding fathers and founding mothers who are reluctant to hand over the reins to the kind of current generation of the family members?
Yeah, it's a good question. I think the obvious answer is that the patriarch needs to be engaged and convinced that this is a real topic that needs to be addressed. I think quite often, and I would see this in other markets as well, particularly when one is looking at the founder generation, typically the founder will realize that this is an issue, but the founder is so busy building or consolidating his or her business that the details of an eventual succession plan or the details of family governance plan and how the business will be governed in subsequent generations is something that the founder realizes has to be addressed, but it's never a top priority. So
Yes.
it's engagement, I think, is the...
Absolutely. And Mohammed,
Yes, actually, I definitely agree with Hussam and Michael. But from my own experience in this market, I think now the picture is totally changed. And I don't want to say many, but most of the family groups started to realize the importance of the succession plan. From my previous experience with my previous employer, we engage a third-party advisor who done a family constitution, family Bible, and we have a very solid and rigid corporate governance on the board level. And basically, the main reason for doing that is the loss of the main founder. So the second generation started to realize the importance of the succession plan and the challenges that they are going to face and to inherit this to the third generation if they don't have a documented and well-planned succession plan for the transfer of the wealth.
very interesting. So Hussam, obviously there's an element of trust here and handing over the reins. How would one sort of open up discussion, and how would one bring in third-party mediators?
It's very important to have a third party. It's very, very crucial for the company to survive. Because you don't need to always be focused on the family. When it's a family business, it's not only about figures, profit, and pure business. It's also about emotion. So when you need a third party advisor, lawyers, or whatever you want, it's very important. But because it will give you another vision. But the problem is that you have to involve someone, another entity which is not part of the family. So you have to trust those people. And most of the time, the advisor will tell you, this is what you have to do. But it's not maybe in line with the strategy of the family. So it's always very complicated to involve people who are not from the family in a family business. But this is crucial. So that's why I believe that most of the company have to adapt their strategy to the family office and family business. It's not about only advising and giving maybe the best answer, but there is a way to give this approach and tell to people you have to do this. Maybe it's not in line with what your family has been doing since the beginning, but this is what you have to do. So I think it's a question of trust before all, and that's the only way for companies to survive in a changing world. We are not like 45 years ago when the UAE was built or most of the GCC built. We are in a changing world, globalized, and we need those advisors to give you another overview of the market and of the situation.
Absolutely, good point. And Michael, for example, a lot of family offices are prepared and they have put in place strategies for succession planning. What things should they be focusing on when they sort of try to implement an effective planning?
Well, I think there are a number of focus points, and just to follow on to your comment, we notice that there's a bit of a difference between certain markets in the region, and that certain markets are more mature in terms of their wealth. So rather than having a scenario where you're perhaps, for example, maybe a Qatar where a lot of the wealth might be first generation. If I look at our Kuwaiti or Saudi client bases, that quite often that wealth is a lot older, and as a consequence, we're into a second or third or maybe even fourth generation scenario, and the need to bring in neutral or external parties to help with succession planning was perhaps recognized earlier on, and they're acting a bit more on the basis of example and prior best practice. So it's perhaps not as new in some countries as others. We would also, on your point, Najat, we would certainly see a split between how onshore wealth is treated versus, let's call it offshore private wealth that's being extracted from a business. On my side, that type of planning tends to involve using trust structures that are adapted to address Sharia requirements, as an example. And it's by and large, this is a bit of a generalization, but by and large, it's easier to plan around succession topics with respect to private wealth than it is the inheritance of a business and the governance of a business and managing all of the very different stakeholder claims that you might find in a business scenario, in terms of family members who are simply expecting to receive a steady stream of income versus those who are closely involved in the business and want to build the business. So it's a much more complicated topic, I think, on the business side. Yeah.
Mohammed, any comments on that? On the key aspects that one must bear in mind for an effective handing over, effectively?
Actually, one of the key aspects in terms of the handing over is the preparation of the second generation. And now there is an upcoming trend in sending the second generation abroad for learning, and even they advise them to work in different companies outside the family legacy. This is to give them much exposure and much interaction with different businesses, so they don't grow up only under the legacy of the main founder. And I think, personally, I supervised in my previous employer to send 3 of the family members abroad in UK and to work with private bankers for internship of 6 months.
Okay, interesting. Yeah. We'll come back onto education a bit later in the discussion. Hussein, what about the role of board members? Traditionally in these family offices, the main founding fathers and mothers would be relegated, as it were, to become board members, sort of non-actively running the company, but effectively have a say in ultimately where their company is heading. What do you think of that sort of that structure?
The board members play, I believe, a crucial role, but in most of the family businesses in the GCC region or in the MENA region, the board member is not maybe playing the role it should play. I explain you. You can see a lot of board members in many companies, pictures, biography, etc. But at the end, the question is, what is the role of the board member? The board member has to be the link between the management of the company and the vision of the family, the founder of the company, the ruling family of the company. And we can wonder if this board is playing the role it should be, and I don't believe so. Most of the time they are just here to represent, but at the end of the day there is one decision maker. It depends. It really depends on the company. Some of them have a better structure than the others, but most of the time I think we don't realize how board members are important. It's not only about giving a direction for the company, to be a driver for the company. It's also about giving another vision to the company, giving more transparency, giving better strategy for the future. It's also about advising the founder of the company. So it's something very important. And I think more and more in the MENA region, we have to encourage the board to play a crucial role to make this company successful.
Michael, do you agree with that? Do you think these retired members do make invaluable contributions to the running of the firm?
I think you're alluding to a classic problem, yes, irrespective of market, where in the founder or first generation, quite often the board will be a captive board, so captive to the founder. It'll more or less rubber stamp what the founder wants to see done in terms of corporate actions. But as you move on into subsequent generations, and presumably as a business grows, the need to have well-qualified external individuals on a board who have actual power becomes much more important. And certainly we would notice that managing there's a bit of a conflict in terms of the dynamics between non-family member, professional, external members of a board versus family members who are part of the board. There are obviously scenarios where family members have a certain entitlement, whereas then external members might feel that their contributions aren't being taken into account. But I think when one looks at the literature on successful, multi-generational, successful family businesses, inevitably bringing in fresh talent at a board level or just at an executive level, it's always one of the key ingredients to success.
Yes, and good point. And Michael, being anchored in Switzerland, do you see a difference between the way Arab family offices are run compared to the European family offices? And can one learn lessons from the other?
I think at a very high level, the European family offices typically have just been around for longer, right? So there's more of a track record or a history that one can refer to. So that would be the fundamental, I think, difference. When we look at European or North American families, quite often the governance rules in terms of who can be involved in a business, in terms of which family members can be involved versus those who cannot, and how you make that judgment as the generations move along, tends to be more rigid and set out in some type of plan, whereas in the Middle East, I think perhaps for cultural reasons, there's perhaps a greater likelihood that family members are expected to become involved in a business and stay involved in the business, right? And that's a bit of a different thing. Yeah.
That's a valid point. I mean, Mohammed, coming on to that very final point that Michael made, in terms of family inheritance versus merits, do you think there is something to be said in terms of family members who inherit the family business vis-a-vis talents? You may find some family offices where the younger generation are not qualified to lead the company. So how would you sort of comment on that aspect of family inheritance versus talent or lack of?
Yes, actually, the family inheritance versus merits, and from my own experience, I can say that this is not the case right now. Most of the family try to get external chief executive officers, CEOs, to run and the business if they lost the main founder. And also I have to add, if the second generation is not qualified to run the business, I think the shareholders is not going to give him the trust. And following the comments of what Michael said in terms of the external board member, and I think this is an urgent need for most of the family groups to engage independent board member. But the main problem is the survival of the independent board member. I found many cases that after 2 or 3 board meetings, the independent board member resigned from the board. And actually, this was a very big issue for them. So I have to assert that the structure of the group itself play a vital role in the inheritance for the second generation.
So Hussam, following from that, if disputes occur, how are they settled, given we have the Sharia compliance aspect, the jurisdictions of the company where it's formed, if they have a footprint in Europe, how are these disputes settled?
Just one point, just to react to what Mohammed said, just a very short story. There is one of the biggest family business in the GCC. I'm not going to mention the country because you will directly recognize. But it was the 3rd generation. It was built by the grandfather. The father was doing a great job. And then the kid came, they were preparing him, like 5, 6, 7 years before you start like a training to see how the company works, etc. And they saw that this guy, he's not ready at all. He was spending more time driving his nice car, parties, etc. And he doesn't care at all about the company. But the problem is that he has the name. So it's like, it's like a monarchy. He is the crown prince. So he has to be the ruler of the family, the CEO of the family business. But as Mohammed said, now it's not working like this anymore. Maybe not in the big firms, at least. So the board refused him, and now they found a cousin to replace him. So in big companies, it's not working like this. Maybe for small companies where nobody's checking what you're doing, it's still like this. But in big firms, it's changing, and it's a very good point. Yes. So it was a very short story. Now regarding disputes, it's a very complicated issue, and I don't think we have one answer for that. We have to remember that most of the MENA countries are regulated by Sharia law. This has to be bear in mind. Now, the regulation is always a mix between, for example, the Sharia law and then Egyptian law, for example, in the UAE, which is inspired by the French law. So first, for family business, when you have a dispute, when you have any problem inside the company, the first way to solve it is inside the company. This is the priority. Let's solve it inside the company because it's a family business. It's like inside your family. If you have problem, you try to solve it inside your family. Then if you have to go to court, you go to the court. So this is the first way to do it. The second way, if you have to go to the court, yes, it's regulated by Sharia with, as I said, a mix of Egyptian and French law. And more, you have to notice that family business, maybe more family office, go to DIFC, for example, in the UAE, or Abu Dhabi Global Market, Abu Dhabi ADGM. Why? Because it's regulated with a law inspired by the British law. And it's defined a framework in order to solve disputes. Because most of the company, my role at GDC Partners is to attract European company and set up them in the UAE, as I said. And most of them are very worried about, okay, but if tomorrow there is a dispute with Ben Hamouda or with another partner we work with, how we're going to solve it? So you're not going to just tell them, okay, we will find a way inside the company. No, they tell you what's the regulation, how we're going to solve this. So it's something very important. That's why most of the MENA countries, not only the UAE, but Saudi and others, try now to find a regulation inspired by Western countries in order to solve the issues. It's still a problem, but more and more they are finding a way to solve that.
Interesting. Michael, have you found this at UBS in Switzerland? Is it more a case of, with some of your clients, is it Sharia law or commercial law? Which wins out?
Sorry,
with the family offices, is it Sharia law or commercial law? Which do they tend to follow? Or would they sort of try to keep things insular within their jurisdiction in the Gulf region, for example, or take it out to their offices in London or Paris?
It's a bit of a mix. Most of the clients, most of the family office clients with whom we work are certainly booking assets on a multi-jurisdictional basis.
Yeah.
And Switzerland and the UK would be the
Yes.
two main ones. Quite a lot in France as well, actually, which is, I think, a bit unique to the region. You don't necessarily see that so much in other markets. I mean, certainly, just in terms of just a pure banking relationship, if the account is in Switzerland, then obviously Swiss law governs the actual banking relationship itself. If I compare what I see in the Middle Eastern region to, for example, the Russian market, which would be my other main focus, in a Russian context, you would definitely see steps taken so that there's always recourse to foreign law, particularly English law, and that's less so I think in the Middle East because steps have been taken through DIFC, etc. to remedy that. Yeah.
Mohammed, do you find the same experience?
Yes, but I think here we have to differentiate if there is a dispute arise from the inheritance. So definitely it will be as per Sharia law. But as Michael said, if something related to multi-jurisdiction investment, so it is purely commercial law. So assume that we have offshore investment in Switzerland or in UK, so we are not going to stick with Sharia law. So purely it will be English law.
Okay, interesting. Yeah. If we move on to sort of the differences between the founding fathers and the current generation, and the differences in innovation and approaches to amassing and retaining wealth, have you found there's a diversification of wealth management and investments from traditional asset classes into different types of classes? Hussein, what have you seen in the market recently?
It's a very, very important question, and I think it's more than just an idea innovation. It's once again, it's maybe the most important question for the business families, and most of them will not survive if they don't change their mind. I will try to explain what I mean. Most of the family business were founded, like, let's say, 40, 50, 60 years ago, when the GCC countries were born, we can say. So it was another world. Most of them are in infrastructure, food and beverage, services, banking. But only few of them innovate. By innovation, I'm not saying a new concept. I'm talking about real innovation, disruptive innovation. And most of them, and tell me if I'm wrong, but I'm saying most of them, not all of them, they import brands. They are just bringing franchise. Yes. You don't innovate when you bring franchise. Okay, I bring Rolex, I bring this. That's very good, but you don't build a country on this. It's not possible. So you cannot have a long-term vision with an old way of thinking, like only construction services, and at the same time bringing brands. You have to build something in the country, something innovative, something new. And most of the family businesses today, they are not doing this. I'm talking, once again, most of them. There are some few that are doing this. So that's why more and more, I think they have to focus on innovation, investing in startups, in venture capitalism, investing on something new, because the world is changing. So you cannot keep the same methods as before. You have to adapt to a globalized world, changing, and you have to focus more on innovation. And this is not the case. And the reason why it's not the case, this is my viewpoint, maybe you're not going to share it. It's because the MENA region is not prepared, ready for entrepreneurship. There is only few entrepreneurs in the region. I'm talking about innovation, etc. And that's why we have to change the mind of the region. Otherwise, I believe that we're gonna, some of the economies will collapse in the future, because we are going to go to further and further in a changing world with old methods, and it's not possible. So yes, they have to diversify, not only invest in real estate and fixed income, but think out of the box, innovation, new technology.
So diversifying for survival. Michael, your comments?
I would agree. What you've just described are a classic client profile, right? Which it tends to be someone who had a concession for a very attractive product or service, and the wealth was generated on the basis of that concession over the last few decades. What's interesting, and maybe it's a little bit paradoxical, and I take your point about innovatively investing within the region itself. If I look at our, particularly the second or third generation family members within our client base, where the business may still, the local business may still be that concession-based business. When it comes to how those individuals invest bankable assets outside of the country, they're probably some of the, if you look at our global client base, they're probably one of the segments that's the most interested in exotic private equity type investments that we would have to offer. So they're certainly investing in that sort of stuff through a banking platform outside of the country, but perhaps not being innovative inside the country would be the distinction.
Yeah.
Mohammed, your comments on diversifying?
No, I think, I fully agree with Hussam. There are quite a few companies in the GCC who actually encourage innovation. They always have a fear from the new things. So they are totally keep the same businesses from the previous generation. So now I think, the trend now try to little bit to change and encourage the new innovation, especially that if you are following the news, the online shopping now. So I think most of the companies working in the retail segment try to penetrate this area in GCC.
Is there, Hussam, do you think, a disconnect between the innovation and the diversification of assets, investments from the kind of current generation vis-a-vis the kind of founding fathers? Is there an issue here that you've seen in the MENA region?
Like diversification between the current generation and the previous? Yes, of course. Once again, we have to keep in mind that before, when they created the company, when they launched it, it was a closed world. The UAE, let's take the example of UAE, we can take Egypt, Jordan, Saudi, or whatever. But it was very close, so you just do business with your neighbors Or you see, we are not globalized. We don't know what's happening in Europe, for example, or in USA. Now it's a different world. We have to keep in mind that internet is everywhere now. So anyone knows what happens in Bangladesh, in USA, in Dubai. So the new generation, I think, will give a message of hope to diversify the portfolio and stop investing only on fixed income and real estate. What Mohammed says is right. Most of them, they invest in assets such as, we can say, real estate, giving stable return. Their first question, I'm going to give you a very quick example again. We have an amazing opportunity. We are representing a firm offering a new product. It's in very innovative products in application. And we went to raise fund in the Middle East. We invested in this company, but we are looking for co-investors. And each time their question is, what about the risk? What if this happened? What if that happened? Of course, it's very normal. Every private equity company in the world will ask about the risk. But there they ask you so many guarantees that at the end of the day, you don't want to launch your product. You're scared before starting your business. So I think, as Mohammed said, they need to learn how to take risk and, okay, say, yallah, we try it and we will see. And diversify their portfolio, not always things that are guaranteed or giving fixed income, but diversify. And just, it's my viewpoint, investing in real estate will give you a very bad return in the coming years if you still are investing all your assets in this, because you don't know what happens. Look what happened like less than 10 years ago. What will you do? So maybe it's better to invest on innovative companies, small amounts, but that will give you 10 times or 20 times your return. So to answer to your question, yes, I think there is a message of hope for the new generation.
Michael, are you seeing this? Are you seeing a diversification of investments into startups, tech, different types of funds away from the traditional asset classes?
We as I mentioned, we certainly see an interest in investing in banking products which are investing into those types of businesses themselves. And that's more of a second or third generation type of approach. I think one of the other big factors as well is that it's very common to see second and third generation family members having been educated here in the States. And of course they come back quite often with a different mindset and a different approach to these sorts of topics as well. So I think it will gradually change as time goes on.
Mohammed?
Yes, I fully agree with Michael. The main point is the risk profile of the family. Is it risk averse or risk tolerance to take the risk and invest in innovation, as Hussam said. But I think now it will take time to gradually change the mindset of the first generation. For the second generation and the third generation of the families, I think they are totally realize the importance of the high tech and digitalized investment nowadays.
Mm-hmm. Yes. Before we go to questions, Hussam, just to wrap up, what would be your top two tips for a sort of seamless strategic handover in terms of family planning?
The first one is to prepare very long time ago the succession. And the second one is to adapt to this world. Once again, we are in a changing world and you have to adapt your strategy to it.
Mm-hmm. Michael?
Certainly planning ahead. I mean, this is the number one issue. One of the standard scenarios we would see is year in, year out, a client acknowledging that this is something that has to be done, and then all of a sudden arriving and saying, now it must be done within the next month type of thing, and that's not necessarily realistic. And I think also flexibility is key, because there's quite often a tendency for people to try to plan in a manner which controls events far out into the future, and that may or may not be successful, but certainly you would want to build enough flexibility and to adapt to unforeseen changes. So.
Absolutely. Mohammed?
Yes, of course, to have a developed and planned succession plan. And one important point I have to mention is communication.
Yes.
Communication is very important amongst the family members. which is very difficult to find a proper communication among the board members or even the family members. So communication is one of the essential points that I have to put on the top of this.
Yes, very
I would
valid
agree with
points,
that.
yes.
We have a team that spends a lot of time helping clients put together family constitutions, and you can, of course, debate
Yes.
the legal ramifications of that, but certainly one thing that exercise does do is force communication, right? And I think in and of itself, that's a good thing, right?
Yes, excellent points. Thank you so much. Let's open the floor to questions. If you have a question, please raise your hand on any aspect of succession planning, family offices in the Middle East or any different region. Yes?
Thank you. My name is Stella Kamitsi. I'm from Cyprus. I'm a lawyer. Just one question on the succession planning. Is there a tendency for creating, let's say, trust or wills in the Middle East for wealth management succession?
Okay. Trust or will?
Certainly, in respect of offshore private assets, we see a lot of trust-based planning, yes. Yeah, definitely.
Yes.
But locally in the countries?
No, the trust usually will be offshore. Yeah.
But the offshore trust, can it also include assets located locally in the Middle East?
We certainly have clients that would, for the classic scenario, they would be using a private trust company to indirectly hold a local
That's
business.
quite the norm.
Yeah, exactly.
Yeah.
So we can have offshore SPV which can own the local assets.
But it's not something easy to implement.
Exactly.
So that's why I think they go offshore.
Yes.
Yeah.
But also you have offshore inside UAE, for example, in Ras Al Khaimah or Dubai. So it can be done inside the UAE, but offshore. Even it's not the UAE regulation, it's based in UAE.
Yeah.
Okay,
Thank you very much.
Any other questions? George?
Could any of you touch on the role of philanthropy in engaging next generations?
Great point. Role of philanthropy, which is quite the norm, I would say, in most family offices. They have a trust or philanthropic goal they're working towards. Hussam?
It's something very popular in USA or in Europe. In the GCC region, it's starting. A lot of families are now helping foundations. A lot help refugees, helped for education, many projects. So it's something that started and that has a great future, I think. Yeah.
Any other comments?
Yes, exactly. I think, most of the families in GCC, and from my previous experience, they have their own charities under their name.
Yes.
Yeah.
Yes.
Yeah, it's becoming the norm, actually, isn't it?
Yeah.
We see it's more and more often setting up educational charities, foundations, either locally, domestically, or internationally, and they're growing in importance, actually. Yes.
And something very important in what you said is it's a family business. Once again, we have to focus on that point that it's about a family. So family, as I said at the beginning, it's not only about what's your turnover. It's about the image of the family,
Yes.
the value, the vision. So being involved in philanthropy, even if I'm sure most of them really need to help, but it's also a good way to change the image of the family and to promote themselves. So that's why also is booming. As you said, a lot of, maybe most of the big families have foundations.
Exactly. We actually, from my own experience with my previous employer, we established a fund dedicated for the charities works. Yeah, but locally, not internationally. Yeah.
Okay, great. Thank you. Any other questions? Yes, gentleman here.
I just want to return to diversification, because if you talk to most family offices, capital preservation is a big priority. But if you do the maths with Middle Eastern family offices, you've got to grow your capital. If the principal has 5 children and those 5 children have 5 children, you get into the hundreds pretty quickly. And traditionally, as you say, real estate has been the focus. That isn't going to feed 265 mouths. Now, I've seen in recent years sort of almost foundations, money being pulled off one side for sovereign family wealth funds and the rest returning into recycling in the business. But just a little more from your experience how you're going to address, unless you get Western nuclear families, 1.5 children, the cake's got to spread a long way in 3 or 4 generations.
Okay, great question. Thank you very much. Diversification. Michael?
I completely agree, and it's I think in many respects it's a problem that's unique to the region, right? That's probably compounded by the fact that in places like the Middle East and other emerging markets like Russia, the clients typically are used to seeing double-digit rates of return within their business itself, and are completely astonished by the fact that banks can't offer them predictable double-digit rates of return on standard financial investments. So it's a big problem, and I'm not sure how it can be addressed other than people working themselves, right? Might be the answer.
Great. Any other questions? Take one more question.
Just one remark about what you said, very short. We cannot understand what are family offices or even business, family businesses if we don't understand the history of the region. We have to remember that most of the countries are very young, 45 years old for the UAE. Most of them are less than 60 years old. So maybe some of you are older than those countries. So you see they are still learning. And when you are learning, you cannot expect from those families to be like what's happening in London or in Paris or in Frankfurt. You see what I mean? They are learning. And they have built the nation on trade, most of them on trade. So now the concept of family office, private office, is something very new. So it's normal that they are looking for stability, especially when you take into account what happened a few years ago when they lost a lot of money in investing in some assets. So now they are scared, they need guarantee, they are still learning, they are still understanding that, okay, you can invest outside your country. It's a slow process. So we have to keep this in mind, but that's why I believe that diversification will take time. They started, it will take time, but it will at the end follow the steps of Europe, and they will invest more and more in innovation in other countries, etc. So yeah.
Yes, it's a slower process, but the family offices in the Middle East are growing in sophistication. Yeah. So I would say, basically watch this space. Well, thank you very much. I'd like to thank our presentation by Bartosz Golba and also our panelists, Hussam Nasrawin, Michael Addison, and Mohammed Hilal. Thank you so much.
Thank you.